So good morning, everyone, and welcome to this webinar on trading fundamentals. My name is Steve Mills, and I head up the TSX Company Services here in Toronto. And really happy this morning to talk around trading. Trading is probably one of the biggest questions that we get here at the TSX. Everything from anonymous trading to market making to different brokers buying and selling your stock. So really happy here to do a little bit of a deeper dive on some of the more common trading terms. And for the purpose of today's session, I have two of my colleagues here that have joined me this morning to shed some light on some of these common areas. So for the first half of the discussion, I have Vic Ciampini, who's heads up our market making program. And Vic is going to be covering 5 topics today. So we're going to be talking around some of the common trading terms, liquidity in your trading, common stakeholders that we come across in the market, market making, and how to work with IIROC. Vic, do you want to give a little bit of your background?
Sure, thanks, Steve. Good morning, everybody. So my name is Vic Ciampini, and as Steve mentioned, I work with the TSX Market Making program, but I work very closely with the entire TMX equities trading team. I started here when the trading floor was still open on the trading floor, and since that time I've acted in various roles, and I'm privileged to participate in various committees within the exchange as well. That's it.
Perfect. Thanks, Vic. And to Vic's left, we also have Michael Tintinaglia. Michael is our BD Equities Trading Manager. And the 5 topics that we're going to cover with Michael include alternative trading platforms and dark pools, anonymous trading and short selling, derivatives and option trading strategies, some events that may cause price volatility in your stock, and last but not least, the one that everybody always loves, stock manipulation. Michael, do you want us to give us a little bit of your background as well?
Yeah, thanks, Steve, and good morning, everyone. So I've been at the TMX for 5 years. I am part of the equity group in the business development. Basically, I cover Canadian accounts, banks, and West Coast. But a lot of part of my job is to go down to the U.S. And try to convince people to use their strategies to trade up in Canada. So I do talk to a lot of liquidity providers down in the U.S. Prior to coming to TMX, I was an institutional equity trader for 13 years, trading at small boutique shops all the way up to an international bulge bracket firm. I have a CFA and my master's degree in finance from Rotman. And like Vic, I am part of the equity team and on the committees that help sort of steer the TMX Market Group.
Perfect. Thanks, Michael. And right at the end, I'm going to actually cover a little bit of the major tool that we provide for our issuers that helps track all your trading activity, which is InfoSuite. So I'm going to cover a little bit of that right at the end. Just from a logistics perspective, I'm going to be asking some questions to Vic and Michael, and we built in some slides online that you can kind of follow along the topics as we go through. So with that, I say maybe we get started right into the first question. So Vic, I would say, you've been at the TSX for a while now, so what would you say are some of the more common trading terms that you think you want to highlight for the audience today?
Sure, yeah. I mean, some of the most common and fundamental terms in the trading environment, but are really the building blocks of understanding how it works, are what is a bid? So you have a bid, you have an offer, you'll have spread, and you'll hear quote. So those are 4 pretty common terms, and what do they mean? So a bid is really an expression of interest at a given time, a committed expression of interest in any order book that basically states the price that a buyer is willing to pay at that point in time for a certain volume of shares. Whereas an offer, obviously, would be the opposite of that. That is a committed order in an order book that states the lowest price a seller is willing to sell at that particular point in time, and also states the volume of that order. A quote, which is a pretty common term, that refers to the best bid and the best offer at any given time in the order book. So the bid, the quote will always have a bid price that is lower than the offer price, and the gap between that bid and that offer is what's referred to as the spread. And for investors, the smaller the spread, the more efficient trading can take place on that stock, because it narrows the buy and sell points if you're transacting in and out of the stock quickly.
Perfect. And how would you describe I think that leads into the second question around liquidity. So what is liquidity? Why is it good? What's the market depth? How does that all work? I mean, that's one of the major things that
that's an important thing for sure. Liquidity is really just an expression at a high level of how easy it is to transact on any given stock. And in practicality, what that really means is what volume of committed buy and sell orders are existing in the trading book at any given time. And the most important aspect of that, the thing that makes the stock more liquid is how much of that liquidity is concentrated at the quote that we were talking about, or close to the quote, meaning that you can come in with average size buy or sell order and easily get a fill near the best price, or even if the order is a little bit larger, if there's enough liquidity near that top quote, you're going to be able to transact even larger orders in a more efficient manner without having to pay up larger price levels on a larger buy order or sell down at lower price levels on a larger sell order.
So basically, the more liquidity, the less price movement there will be on larger orders.
Exactly, yeah. Okay. The greater the liquidity, the less price disruption occurs in being able to satisfy incoming orders.
Okay.
And to put it together, you could say that the liquidity also affects the spread that we talked about. Okay. So a higher liquid stock will have a smaller spread, so that you're not having to pay more pricing just to get that much more liquidity.
Okay. And is that, so and you see all that within the market book, or the market depth? Is how it works.
Yeah, so market depth is a particular component of the trading book. So you might think about, the quote is the best price and the best bid and the best offer. Market depth then refers to, and there's a slide up on the screen now which gives you an example of that. That starts to refer to how many buy orders are in the book and how much volume at prices below the best bid price, and conversely on the sell side, how many orders and how much volume is in the book at prices above the best sell order. And the greater the market depth, once again, also helps to satisfy larger incoming orders that may move past the best price, but then still have sufficient volume outside those prices not to have to move the price too much on one transaction.
Okay. And I think it can also kind of show a little bit around where your price may stabilize, if you have good news or bad news, if there's a large order at a certain
Absolutely,
point.
yeah.
So I would say, if anyone does have any questions around the market depth and liquidity, do reach out to whether it's myself here in Toronto or our issuer.services@tmx.com email, or any of the other heads across the country, and we can go through some examples of how your stock looks within the live market depth and the market book as well. So thank you for that. Stakeholders. What kind of stakeholders do you normally see in the marketplace?
Sure. Yeah. The main stakeholders we see, you have the retail community, and that's basically you, me, the person next to you, and most of these orders are going to trade as what we call client orders. And then you also have what's called the buy side. So these are large institutions, asset managers, who aren't directly trading, or they're not direct brokers of the exchange. However, they will enter their order flow through what we call the sell side. And the sell side is just simply all of the direct brokerages that are what we call participating organizations, who have direct connections to the exchange and have an agreement in place where they can enter their order flow directly. And then you have, generally speaking, liquidity providers. So we described what liquidity is. Now you also have various entities that are just strictly there to provide that liquidity. So you have just generic entrants in generic participants who are there just to be liquidity providers trading their own capital. And within that definition, we also have TSX Market Makers. And they as well would be referred to as liquidity providers, among some other obligations they have as well.
So that leads into a little bit around market making, and you head up the market making program here at the TSX. How does that, just for the benefit of the audience, what is the market making? How does it work? How do they get assigned? What are the benefits for our
Sure.
our issuers?
Yeah, absolutely. So the TSX has a market making program and has for many, many years. And the role of a market maker is to really ensure the strongest possible marketplace for investors and issuers alike. And how they do that is through various obligations and performance targets that they have. So a market maker will ensure that there's always a two-sided market on every single issue that they're assigned to. And they may have to step in more directly when natural forces haven't provided a two-sided market. And then they also are going to guarantee smaller retail orders, a complete fill at the best posted market through a facility we call the MGF facility, which stands for minimum guaranteed fill. Market makers are also guaranteeing what are called odd lot orders, and we'll get into the description of that a little bit later. It's basically very small size, generally retail orders that aren't able to transact in the regular order book, which trades in multiples generally of 100. Market makers that are to take those orders and fill them as well. And recently, of note, we introduced what we call the dual market making program. Whereas previously we had one market maker assigned per issue. We introduced this program in March of 2018. And some of the key components of that program and objectives were to introduce a more modernized set of performance metrics. The old program had been in place for quite some time and hadn't seen any changes for quite some time as well. So in introducing the secondary program, we upgraded the metrics, and we saw an immediate increase in market quality on the TSX. Tighter spreads, greater volume at the top of the book, and that goes back to that liquidity we were discussing earlier. And also the TSX quote, or the TSX increased their time at what we call the national best bid and offer. So the quote here was equal to or better than the national best bid and offer in Canada, greater than 99% of the time. So there's definitely been gains, but it all comes back to providing, contributing to a quality market for investors and issuers.
Okay, and if an issuer wanted to find out who their market maker is, how do they go about that?
Yeah, the issuers can either contact their business relationship manager or myself directly, but probably more efficient to speak with their business relationship manager, such as yourself, and we'll get them all that information. Cool. And they're more than welcome to have a conversation with their market makers and vice versa, and obviously, just don't divulge any inside information.
Sure.
But,
Yeah, I would say to anyone that does have questions around the market maker, don't know who your market maker is, then reach out again and we can provide that contact details for you. One point did want to just highlight again is market making, the TSX market making program is for TSX issuers. On the venture side, we don't have a market making program currently for them. It is something where they can look to hire a market maker, but we do provide the market making program for the TSX issuers at this point.
That's right.
Yeah. IIROC. Can you tell us how do we work with IIROC? What should issuers know around IIROC? How to deal with them? What
Sure.
do they do?
Yeah, absolutely.
What do they stand for?
So IIROC is the what is that acronym?
Investment Industry Regulatory Organization.
Thank you, Mike. Sorry. So many acronyms.
Yeah.
But essentially what IIROC does is they monitor and enforce what is called UMR. And UMR stands, that one I do know, Universal Market Integrity Rules. Okay. That encompasses a number of different components. One is direct market surveillance of the actual trading. And there's various components of UMR that prescribe various behaviors that are acceptable and some that aren't. From an issuer's point of view, though, the main component that would be of interest is the timely disclosure. IIROC monitors timely disclosure on our behalf, and so for an issuer, you want to make sure that you're always informing IIROC if you have news you're about to release. Some of it's material, some of it's not. But if you're unsure, you can reach out to IIROC as well. But it's important, just that in all aspects of releasing news and timely disclosure, that you're in contact with IIROC and just make sure you know the parameters around what needs to be released, when it can be released, if a halt is required, that type of thing. Yeah.
Okay. And do you want to chat around maybe the hours with IIROC, or when issuers should reach out to them? Or?
Sure. Yeah. I mean, IIROC is generally available, I believe, from 8 till 5. Earlier in, sorry, not earlier, but the pre-open session actually starts at 7 a.m. So not trading, but order entry is available from 7. But the earliest trading in Canada is 8 a.m. and that would be our alpha market. Alpha trading system and some of our competitors. But generally, IIROC will be available from 8 till 5, I believe. The regular market hours on most listing markets open at 9:30. But because trading does take place prior to 8 or starting at 8 a.m. on some marketplaces, if you have something to release in the morning, it's important that you get on with IIROC maybe the night before or whatever and get everything lined up.
Yeah, so essentially if there's material news, then we would, you do need to contact IIROC within those market hours, right, between 8 and 5.
Yeah.
Just make sure they want to make a decision whether or not they're going to halt your stock or not. And if it's outside of those hours, then you can send the press release out there. Yeah. I've always looked at IIROC too, just personally as, yes, they are the police. Basically, they will halt your stock, but they're also there to help. If you do have any questions around, you're not sure, you think there's, we'll get into manipulation in a little bit, but something fishy going on with your trading, they're there to help you. And issuers pay listing fees to the TSX, and the TSX IIROC is separate from us, but those fees help fund the whole surveillance through IIROC as well. So from our side, those were the kind of general kind of areas wanted to touch upon with Vic. I don't know if we want to take, if there are potentially any questions at the end. Again, please reach out to the issuer.services@tmx.com and we can answer any questions that you may have at that point. So thank you for that, Vic.
Yeah.
Michael,
yes.
We'll get into some of the other fun stuff that we'll cover here today. So bigger questions that we get, and this is probably a big one that I hear quite a lot myself, but alternative trading platforms, what are they? Dark pools, are they bad? Are they good? What are they hiding? Tell us, what are your...
Okay, so let's just do a quick definition check here. So an exchange is a regulatory name for somebody or an organization like the TMX that allows for listing of a company for public trading. An ATS is an alternative trading system. So what happens is we are an exchange, the venture is an exchange, our competitors CSE and Equitas are all exchanges, they all have their own listings. We trade our own listings, they trade their own listings. They can trade and we can trade theirs. TMX currently only trades stuff that we list, but the CSE and Equitas also trade TSX listed names as well. On the flip side to that, there are ATSs, and like I said, an ATS is an alternative trading system, so they can't list their own exchanges, own listings, but they can trade everyone else's. So that's a quick definition of what is an ATS versus an exchange. There's a whole bunch of ATSs in Canada. NASDAQ, so NASDAQ CX, CX2. You have Neo has one, which is Equitas. You also have Omega out there. There's Lynx as well, and there's a couple other smaller ones, Liquidity. So there's a lot of other venues that can trade our stock or the issuer's stock, various locations. So if you don't see something go off on the TSX, it's possible that the order went to another marketplace. to get fulfilled. And there's a whole bunch of rules around that as well as where you can and can trade at a certain time on either the exchange or the ATSs.
And so should they look at each individual trading platform? Like, is it something you should be aware of, or?
Definitely something to be aware of, because a lot of times we'll get questions about, well, I entered into the Toronto Stock Exchange, but it got executed on this thing called Omega. Like, what's happening here? The one thing that issuers need to understand is that there are a lot of rules that govern when something gets traded and where it gets traded. So there's something called a protected market and a unprotected marketplace. So in real quick terms, anything that is a dark pool is unprotected, and anything that is, and I know we flipped to the dark here, but there's also a rule that if you are under 2.5% complete market share, total market share, you're considered unprotected. And that's important because there's something called Order Protection Rule, or OPR, which dictates when and how a stock is filled. So essentially what OPR stands for is if there is a better bid or offer on a different marketplace, you are not legally allowed to trade at an inferior price than that best bid or offer. So there are rules around to protect. So even if you have, say the quote is $10 and there's another market like Omega or CSE or Equitas that has a 10.01 bid, you can't sell it at 10 until you sell it at 10.01 first. So even though there's a lot of various places trading your stock, they are protected by this OPR rule. There are unprotected marketplaces, anything that does impose a latency. So we have one called Alpha, or Alpha market is a speed bump market. So that is considered unprotected. And by that, I mean you don't have to go to that marketplace if you don't want to. So even if they have the best bid or best offer, you could choose not to trade there, and you're not in violation of those OPR.
Okay.
OPR rules, sorry.
Yeah, so generally speaking, though, you can't sell at a discount versus something that's publicly posted. You have to get the best possible price is the major
Yes.
kind of rule of that.
Yeah.
And you touched upon it a little bit, but what is it, like, kind of layman's term, what is a dark pool? How does it work?
Okay, so a dark pool, essentially anything, when I say dark versus lit, a lit market, which is most places, most TSX, TSXV Alpha, most exchanges and ATSs are lit markets. And what that means is you can see the bid, the quote, the price, stuff that Vic was talking about. You can see the market book.
Okay.
A dark market is there's no transparency. So you're not sure what's in there. So you won't know what's in there until you actually go there to see if something's there at your price. So a lot of the times people enter into the dark market because, one, they have a large size order that they don't want in the general marketplace, because that will obviously move the price of the stock if somebody sees 1 million shares to buy. Or there are different types of trading strategies that will kind of go to the dark market as well. But in general, a lot of the dark markets, and there's a couple in Canada, so there's the TSX, which is in between our quote. There's NASDAQ has a dark market, Equitas has a dark market. The biggest one is Match Now, so you'll see a lot of volume going off on Match Now. Most of them follow the quote, and you kind of have to go there to see if there's any volume in the dark marketplace. But as soon as it is traded in the dark, you will see that transparency. So essentially, a lit market has full transparency before and after the trade. A dark market will only have transparency for that trade after it's actually traded. Okay. So it's one way just to protect the quote, protect your order, and sort of hide within the quote of the stock.
Okay. This is probably one of the more common and hard to get your head. For the first time I heard it, it probably took 5-6 times to try and get my head around it. On the benefits, why someone would use it. And so essentially, like when I look at it too, I think of, if you don't want to influence, if you have a larger order and you don't want to influence the price of the stock, is finding that buyer at close to the best price within the dark is kind of one of the major benefits to it without influencing.
Yeah, absolutely. And if you look at some of the market book quotes, you'll see, 100 share bids, 300 share bids, maybe 1,000 shares. But what typically happens in the dark market is that you can put out your whole order into the dark market and no one can see it until you start transacting with it. And still, you don't know what's behind it. So you don't understand what Vic was talking about, the full depth of the quote. And so it just gives you the ability to trade a little bit differently and hide your quotes so you're not affecting the price.
Okay, so I wanted to move on to another really kind of favorite topic around anonymous trading and short selling. So Anonymous trading, why is it allowed? What is it? How does it work?
Yeah, so anonymous trading, I can't remember exactly the year that it was brought in, but essentially an anonymous trader hides the broker number. So Vic was talking about sell side. The sell sides each have a broker number attached. For example, CIBC is 79, TD is number 7. That's how everyone identifies where the trade's happening amongst all the other brokers. So anonymous trading was brought in for broker number 1, and that was basically to hide the broker number. And again, it's just used as a way to sometimes, not hide, I don't like to use the word hide, but use different trading strategies to transact in the marketplace. So if I had a big order that I went through and I bought 100,000 shares through, we'll just use TD, say 100,000 shares through TD, and then I reload on another 100,000 shares, I might not want to use TD again because they might be looking for that again. So I might use anonymous to hide the fact that I have more to buy, but I'm going to use anonymous so that they don't instinctively know that it's me again. So it's just a way to sort of disguise the broker. Gives you a different, different way to trade through. Or you could be, if you're buying or selling, you could be on various marketplaces or ATSs, but you don't want to use your number, your broker number, on each one of those. So it's just a way to hide sort of what you're doing or what you're trying to do, and at the same time, what you want is that liquidity without the price movement. So it just gives you a way to trade the marketplaces, especially with the fragmented marketplace that we have now. Before we used to just be the TSX, it was a little easier because everyone was sort of on the TSX and everyone had to transact on the TSX. Now with all these various ATSs and marketplaces, you can put your order pretty much anywhere, and that gives away information. And information is key when trying to attract liquidity without moving the stock.
So basically not to tip your hand. So if I wanted to get into a larger position or sell out of a position, and someone knew I was a big shareholder, I use that broker ID, I can just spread it around a little bit.
Yep.
Just so, okay.
Or just sort of hide behind the non-broker, the anonymous broker. It's just, again, it's just to protect what you're trying to do so that you don't have high volatility or large price movement.
Okay.
So it's not trying to hide any information.
Yep.
It's just trying not to give out too much information.
And short selling.
Yeah, short selling is one we get a lot. Not all time short selling is nefarious. There's a whole bunch of reasons why you would short sell. And again, there are rules around short selling in Canada. You have to be at a certain price. I believe it's $1 above is when you can short sell. You have to have borrow because essentially when you short a stock, it's essentially you are selling the stock that you don't own in anticipation of buying it back. And yes, you short a stock that's usually too expensive, or you think it's going to have negative news, and then you're going to take advantage of that stock price selling off and buy it back to cover that short. So, not to get too technical, but you have to have a borrow for that short. There is nefarious things called naked shorts, which you're selling the stock without the borrow, but typically that's bad, and IIROC does look out for naked short selling because it can get into some sort of vicious cycles where you're not borrowing and then you can't fulfill the obligation to the other side when you want to settle the stock. Okay. But there's also times when you want to short sell. Like there's times when if you're looking at two stocks or two companies in the same in the same indice or in the same sector, and one's trading at $70 and the other one's trading at $50, but you think the one at $70 is too expensive, what you'll do is you'll short that $70 one and buy the $50 one, and hoping that the prices will converge. There's index arbitrage that you'll be able to do too. So if you see something happy maybe in the US, you can short something against something in Canada. You have, I know deal flippers is on there. I don't like to use the deal flippers one, but some people will take on longer term stock, so 4-month hold stock or 144A stock. And what they'll do is they'll just short the stock against the deal stock and then take the warrant, or they'll just do different various things with that stock that they have to hold versus the marketplace. And a lot of times the deal flipper ones are, if I'm holding 4-month stock, like 4-month hold stock, and the price goes up from the deal, maybe I'll take advantage of that, borrow the stock, short it, and then when the deal, the 4-month close collapses, then I'll just use that new stock to cover my short. So there's a lot of different ways to look at short selling, and it's not always, you're trying to screw the company by shorting their stock down to zero, or these short sellers that just try to get everyone else to do the exact same thing. Okay. But again, there's also reasons that you would short, like some of the ones that you saw, like Sinoforest, where yes, the company was doing stuff that was wrong, and they want to take advantage of that, and they put out a report that said so.
Yeah, and at the end, we'll cover where you can actually find some of the short reports. IIROC publishes the short reports on their website. We have them on within InfoSuite as well too. So we'll kind of touch upon that right at the end as well too.
And if I could just add one more point too,
please
as well,
do.
just one of the points up there as well is market makers are often short out of their obligations. So they're providing sell-side liquidity in situations where maybe the natural liquidity is thinned out or whatever, and they step in, and they're required to do that. So market makers can end up short. Now, a lot of them will try to be flat by the end of the day, but it's not uncommon for market makers to enter or to have short sell orders executed because they're trying to take care of buyers who are coming into the market.
And on the institutional side, you might have a desk like CIBC who has an institutional buyer that wants to buy 200,000 shares, but they can only find 100,000 natural. And what they'll do is they'll just short them the other 100,000, and then they'll take on that risk of trying to buy it back with either little or minimal risk to themselves.
It's interesting because you've both touched upon a lot of different kind of strategies with short selling that for most people we don't normally think of. You normally when you think of short selling, it's someone's just trying to basically push my stock down and think the stock's going to go down. So interesting perspective on that. So one of the other things I wanted to touch upon was, and we don't get into this too often, so I wanted to chat around derivatives and option trading and how does that work, different strategies, when would you see that being used in day-to-day transactions?
So options, depends on what type of options. We'll go with a simple one. We'll just talk about like a call option. And a call option is basically, I'm buying an option from you to buy a stock at a certain price. So if the stock is trading at, say, $5, and I'm not sure I want to buy it yet, but I think it might go to $7, you might buy a call option because one, it's cheaper, and two, it's readily available. So if it starts to move up towards a price I think I'm going to buy it at, or if it moves past that price, so say if it goes from 5 to 10, and you bought that call option at 7, I can go to you and say, Steve, I bought the call option from you at $7. It's now trading at 10. I want you to fulfill that obligation to me because it is a right, and give me the shares that I bought at $7, and you have to deal with the risk of it being at 10. So derivatives trade around sort of those price levels. Again, you might be short at $7 because you know you have to deliver it anyways, and you might buy it back. Or you might think it's going to go down at $7, and you might short it just in case it does go down, and you can sort of capture that price movement. But at some point, if it goes above that, I might come back to you. So another reason to short is just to cover your derivatives trade too. A put works similarly, where if I wanted to sell stock at a certain level, I would buy a put from you, and if I think the stock is going to go down, stock might be trading at $10. If I think it's going to go back down to 7, I might buy a put from you at 10 so that I could sell you the stock at 10, even though it's $7.
So that was a lot of information, and I would say for just everyone kind of following along or trying to follow along on that, options trading with puts and with calls is probably one of the more advanced strategies that you can have in the marketplace for advanced traders that are selling and buying. I would say again, if anyone that wants a little bit more in-depth detail and to kind of walk through it step by step, maybe with custom visuals or so forth, then again, please let us know and reach out on that side.
Sorry, I should have just explained a derivative.
No.
So basically, a derivative, like a call or a put, is an instrument, and the underlying is the stock. So it's not actually like you're buying the stock; you're just buying that right to buy or sell that stock at a certain price, which is called a strike, over a certain period, which is called. What is it called now? Expiry.
Yeah.
Thank you.
Okay. So it gives you the right to buy it at a certain price.
Right. Yeah. That's probably would have been the easier answer.
So we'll touch upon price volatility. So we get a lot of questions around people see their stock just jump or just drop, whether at some point in the market, I have no idea why, where there's no news out there. I would put this out there, and I mean, really for both of you, any common kind of areas where you see that would cause price volatility?
So I think the most common one, and you might agree with me, Vic, is liquidity profile of a stock. So if you have low liquidity, which means you have wider spreads, the depth of book isn't as thick, and by thick I mean there's not that many bids or offers with volume behind the top of a quote. If somebody wants to buy 10,000 shares and there's only 5,000 offered up, $1, you might put a market order in that just moves the stock up like significantly.
Yeah.
There are things that we have in place like single stock circuit breakers, which prevent it from moving too far too fast. Or IIROC might halt it if they do see some price volatility because of that they're not sure of.
Yeah.
So illiquidity is one big reason why we see volatility in stock prices. Down to the micro level, microeconomic level, companies' news, earnings, companies that had earnings that are in a similar sector as your company might be, that can cause price volatility because people do think that maybe if these guys are having these earnings, you might have similar earnings. So that can cause a lot of price volatility. If you want to go up the chain, you can look at macro events. The election that we had yesterday could affect volatility in stocks, and that could be just market-wide volatility in general. International news, U.S. news on a macro scale affects volatility. Then there's also like industry events, like indexing events, where you will have stocks move in and out of an index, and those stocks that are affected by that move in or out of the index will have high volatility around the indexing date. And indexing dates are every third Thursday of the month or quarter, or depending on what index it is. There's various different ones. People anticipate the number of shares that will come in or out of the index, and they'll try to like position themselves beforehand. And even events going into the close. So it's funny, but most of the volume that happens on the stock market happens right after the opening auction, and then you kind of get a dip until about 3:30, where you'll see price movements going into the close. So even stuff going into the close will cause price volatility that you didn't see throughout the day, just because that's when you see most of the volume come back into the marketplace.
Okay. The index events is probably one of the ones for me I wasn't fully aware of until a few years ago. And for issuers, it can be a major event where you'll see your stock go up or down. And you haven't done anything as a company. You've released no news, but just because you're being put in or you're taken out of an index, or people perceive that you now qualify based on some of the criteria, then you can see a lot of the movement from that side. So it is definitely something to keep in mind every quarter for any issuers that see movement on from a volatility perspective in their stock around those times. Okay. Anything from your side on that, Vic, or?
I would say, just kind of going back to the index events as well. I mean, and you mentioned perception. Obviously it's better to be in, it's good to be in an index rather than not in an index.
Sure.
But it's not just perception as well. I mean, as Mike was saying, the fund managers also need to get the appropriate amount of shares in their portfolios and divest themselves as well out of the other ones. And I think the end of day volatility, certainly as Mike mentioned, that's after the opening and into the closes where you get it. But it's certainly, it seems it's been reduced since we introduced the MOC facility, whereas everyone had to transact in the regular market in that last, especially get into the last 10 minutes, it could be really volatile.
All over the place.
So MOC means market on close. So the market on close facility is a big facility of ours. Indexing, especially on those days, there's a lot of volume that transacts in that space. So one of the reasons why we introduced the market on close facility was, one, to reduce volatility into the close, because there could be situations where I need to buy 100,000 shares of XYZ stock. Best time to do that is into the close because we'll see more volume there. But before we had the facility, what would happen is everyone would be racing to buy or sell up until the close. And a lot of these guys, especially indexers, want to get the closing price. So there'd be a big push into the close, which could cause a stock to do this depending on who enters what order at what time. So the market on close facility was introduced to give a period of time for people that knew they needed to get end of day pricing or needed to get a certain volume, where you can enter an order before 3:40, goes into a facility called the market on close, and then we match off buyers and sellers at 4 o'clock when the market closes, and the price of that close will be affected by what price satisfies the most volume at the best price, similar to what our opening auction does as well. But what that has done is given people a facility to put large orders in that aren't into the regular marketplace, allows us to match off buyers and sellers, and then at the end of the day, we will print all that stock. And the nice thing about the market on close facility is that it'll bring in stuff in the regular market book to dampen the volatility. And there's other things we've done. We've introduced separate orders like the limit on close, which goes into the market close as well. And we've allowed for dark orders and iceberg orders and a whole bunch of things that really dampen the volatility at the end of the day, because we don't want major price swings of stocks at the end of the day, because it just, one, doesn't look good, and then we get too many questions afterwards of why that happened.
Yeah.
And typically it's just a supply-demand issue, but the mock facility has allowed us to control better that supply and demand.
So basically a little bit more of a fairer price for everyone to all trade at that one price at the end of the day, where most of the stock can kind of move. Okay.
And just further that, we also publish an imbalance. So if there is a million shares to buy versus sell, or a million more, sorry, then we publish an imbalance where people can enter orders on the opposite side, so the sell side, to balance out that imbalance. So you're not getting big movement at the end of the day.
Okay.
And we do have, volatility thresholds around the facility as well, which, rein it into certain parameters. And there's even the session usually ends at, or usually prints the trades at 4, but that can be extended till 4:10 if the initial calculated price is outside a certain parameter. We'll allow another 10 minutes for just offsetting liquidity to come in to further stabilize the price.
And honestly, we don't like volatility. We don't like to see stocks move for no reason or like up and down too much. Again, that's why we have volatility parameters, single stock circuit breakers, sort of all those mechanisms to prevent that.
This is probably one of the bigger ones that I would find around, where you see a price could jump or drop just right at the close, and it kind of leads into a little bit the next question around the stock manipulation and for someone that's not aware of the market on close, is say, hey, what's happening at the end of the day? My stocks just dropped. What was happening? So it's a little bit more helping explain why you can see those price movements at the end of the day, where more of the stock will trade. So that kind of leads into kind of the last question I wanted to get into around stock manipulation. So if an issuer thinks that something's fishy going on with their stock, what would they do? Who would they talk to? How does it get resolved?
Yeah, so it's funny because the perception out there is that TSX polices trading, in which case we don't. We're just the utility that allows it, and we control that. So if you do perceive there is manipulation in your stock, please contact IIROC, BCSC, any of your provincial regulators. For the most part, IIROC will investigate, but I know that they bring in some of the provincial regulators as well. The nice thing about IIROC is that they have all the information. They see all the information, even if it's an anonymous trade or a dark trade. They see how it was interacted with, what time it was interacted with, all the other interactions that happened around that order, and they can go back to the source of it as well. So they will investigate if they do see a concern. They will investigate thoroughly because they do have all the information. And then if they do deem it something that is manipulation or nefarious, they will then proceed into legal action.
And I might add too, it's even if an issuer doesn't pick up on something and report it, they've got software. They're always monitoring for that, regardless of if it's reported by an issuer or a trader or whatnot.
And I also want to mention that is sort of the last line of defense. Everybody, all the brokers who are regulated by IIROC have what's called a gatekeeper rule. They have to control and monitor, and they have huge compliance requirements to do so, the trading activity that goes through their broker number. So any order that goes through them, the compliance is responsible for. So they will pick up on nefarious trading as well and stop it before it can even make a difference. And if somebody so happens to get through all of that compliance, then IIROC is there to investigate stuff that would be outside the rules.
So would there ever be a situation where they would roll back trades or bust trades at all?
So Vic knows better, but they will roll back trades if information was leaked out prior to a halt, or if a price movement one way or the other happens and they're not sure why. They will halt the stock and investigate. Sometimes it's just a big buyer. Sometimes it's a fat finger. A fat finger meaning somebody put a market order in for 100,000 shares when it should have been 1,000 shares. So they have the ability to halt a stock if they think that something's happening that is not in the fair realm of public disclosure, or is not fair to everyone. If they deem that something was leaked out and it caused a price movement, then they can roll back trades up to a certain point. But typically, if it's on a longer period of time where somebody's manipulating a stock, trades will stand, and then the person that did it will just have to deal with IIROC. And IIROC has fines, sanctions, complete banning. So there's a lot of like areas for them to make sure this sort of doesn't happen.
Yeah, just what Mike said. I mean, most of the cancellations or price adjustments you see is more based on situational volatility events rather than the kind of the long-term investigation.
And I will say again, going back to the whole, we don't police the marketplace. We also don't halt stocks. That's an IIROC decision. We can suspend or not suspend.
Or business halts.
Yeah,
but
business halts.
The majority of them are regulatory halts.
Yeah, yeah. And we don't have an option to take back or cancel trades.
No.
So just on that manipulation, I would say like just one point for I guess issuers, if you are working on, I'd say if there's something material coming out and say it's an acquisition that you're making and you're in contact with another firm, it's always a good point of reference to even just reach out to IIROC ahead of time. Everything is confidential when you do speak with them. So just letting them know that something is coming down over the next few days, it essentially gives them the opportunity to put your stock on what's called stock watch, and they'll look at it a little bit closer. It's just kind of protecting yourselves a little bit that something from your company may not leak out, but you never know based on the other company what could be happening or what was kind of said. So I would view them almost as they're there to help. They're monitoring the marketplace as a watchdog, but they're there to help and make sure things are fairly executed. So.
And I will say, a lot of times we get questions from people about, why is the selling pressure on my stock? Why is it going down? I would say the majority of time, it's for good reason. Either somebody wants to get out of a position, somebody is transitioning into a different stock that might be in the same sector, or they see opportunity somewhere else. And especially from the fund manager side of it, a lot of those guys have obligations that they need to either raise cash or they need to buy something else for like indexing purposes. And unfortunately, your stock got wrapped up in the basket of stocks that got sold to raise that cash. So most of the time, it's not manipulation. It's just somebody has to get out of a bigger position or a position for whatever reason it may be.
Okay. Thank you, Michael. Thank you, Vic. Before we end today's session, I wanted to go through just a little bit quickly. Anyone that's interested in trading and you're an issuer with the TSX or with the TSX Venture, one of the major things that I'll generally go through is our complimentary free tool called InfoSuite. Great tool to go through a lot of your trading activity to see who's buying and selling your shares. As you go through the slides online, there's many different tools there, from alerts to VWAP calculations to seeing from shareholder information around which shareholders are reporting that they own your shares. And that's taken from everyone that owns over 10% and any of the mutual funds that report their share positions. We also, one of the newer features we put in there is the market making performance, where we'll publish the performance of your market makers within the InfoSuite tool, so you can see how they're performing on trading. Some of the other features within the tool around, we talked a lot around short positions and looking at your shorts. One of the things that I would say around the short position aspect is you can go to IIROC to view that. You can view it in InfoSuite. We also provide the short interest ratio, which is basically how many days it would take to cover that short position. And that would be one of the major things that I would say when you're comparing yourselves versus your peers on what the confidence level is in your stock. And if you have a huge short position versus one of your peers, if there's a huge difference in trading volumes, that's where this short interest ratio can come in to give you a better perspective on comparing one company versus the other. So not only the short positions, net house summaries as well, one of the other major aspects of the tool. Probably the most useful aspect around to show you which brokers have bought in the most or sold the most stock. And really that's one of those things, if you're aware of which brokers are the most active traders in your stock. If you don't, then it's something where I would follow up and ask questions to why and see if you have any contacts there at those companies. Some of the other things that are available through the tool that are add-on features, one being we talked a lot around the anonymous reports and being able to trade without someone piggybacking on your news. Being typical kind of in Canada, we do have kind of a middle position, which is we will display who's behind all the anonymous trading. The two catches with it is that it is at the month end, so 5 business days after the new month. And there's a fee to access it, which is $1,200 a year. But it will tell you who's behind all that anonymous trading from the previous month. And at that point, no one can piggyback on all that trading information. So I would say from the info suite side, anyone that isn't signed up or anyone that does want to go through the full features that are available through it, again, reach out to issuer.services@tmx.com, or feel free to reach out to any one of the heads here at TSX Company Services. And I think that's everything from what we wanted to cover here today. Vic, Michael, I wanted to thank you again. Thank you for participating. Thanks for shedding some light on trading activity. Hopefully some of this was useful. And again, I encourage everyone to reach out if you have any questions. Please feel free, and we're happy to help where we can.